The 3 income levels where banks stop processing you and start pursuing you. Your bank has a phone number it has never given you. When you call the number on the back of your card, you wait on hold. You navigate an automated system. You eventually reach someone who pulls up your account while you are mid-sentence. It works. It is functional. It is what you have always experienced. When customers above a certain income threshold call their number, a person picks up within a few rings. No hold music, no automated verification loop. An actual human being with your account already on screen who addresses you by name before you have said anything beyond hello. The difference between those 2 phone numbers is not your credit score. It is not your payment history or how many years you have been a loyal customer. It is your income crossing one of 3 specific thresholds that the bank tracks carefully and almost never discusses publicly. And the phone number is only the beginning. The investment products are different. The loan terms are different. The interest rates are different. The entire financial universe available to you changes at each level. The bank you have been using your entire adult life is running a parallel system right now for other customers in the same building, and it has never mentioned this to you once. Today I am giving you the exact thresholds, explaining what actually unlocks at each one, and showing you why missing these levels does not just cost you a small amount of convenience, it costs you a structurally different financial life. The hotel metaphor before the numbers, one image that explains the banking system better than any diagram. Picture a large city hotel with a marble lobby and a check-in desk that runs nearly the length of the floor. When you walk in off the street, you stand in line, present your reservation, and receive a key card for a standard room on the 7th floor. Everything works. You have a bed, a shower, a small bottle of shampoo. You're a guest. On the 14th floor, there is an executive lounge, different elevator access, complimentary breakfast, evening drinks, a dedicated concierge who actually picks up when you call the desk. The rooms are similar in size, but the experience surrounding them is categorically different. On the 22nd floor, there is a penthouse level. There is no keycard for this floor. You do not check in through the main lobby. You are escorted. Your preferences are already on file. When you arrive, someone greets you by name because they were briefed before you walk through the door. You are no longer a guest. You are a client. Most major banks operate on exactly this structure. 3 floors. 3 completely different experiences inside the same institution. And what moves you between floors is not merit, not loyalty, and not how long you've been a customer. It is income specifically, crossing one of 3 thresholds that very few people know exist, and almost none have ever been directly told about. Which floor are you on right now? And what would it actually cost you to move up? The first threshold, somewhere between $75,000 and $150,000 in deposits. Here is how the first threshold works, and why almost nobody reaches it the way they should. Banks do not think of you as a person. This sounds blunt, but it is the honest foundation everything else rests on. They think of you as a revenue relationship. Every account has an internally calculated lifetime value, how much fee income, interest income, and product revenue you are expected to generate over your time as a customer. For most retail banking customers, that number is modest. A checking account, a savings account, maybe a mortgage, maybe a credit card. You generate overdraft fees and interest on carried balances. You are profitable, but you are a volume play. The bank needs hundreds of thousands of people like you to make the economics work. But at the first threshold, somewhere between $75,000 and $150,000 in total deposits and investments held at that single institution, your calculated lifetime value increases significantly. You become worth the cost of a dedicated human relationship. You become someone worth calling. At Bank of America, the top tier of their rewards program activates at $100,000 in combined balances. The benefits include a significant bonus on credit card rewards, interest rate improvements on savings accounts, eliminated fees on certain transactions, and a meaningful reduction in mortgage origination costs. Chase Private Client begins around $150,000 in combined deposits and investments, unlocking better savings rates, reduced brokerage fees, and a relationship banker who can resolve in a single phone call what would otherwise require multiple branch visits. Here is the thing most people miss entirely about this level. They think the primary value is the fee waivers and the rate improvements. That is not the primary value. The real value is information. Specifically, information about what exists on the floor above, which you had no way of knowing about before the conversation started. The relationship manager who reaches out after you cross this threshold is not calling to make you feel appreciated. They are calling to conduct a financial review. to map your complete financial picture. And during that review, they will describe products and structures you had no idea were available. Investment accounts with institutional fee structures, business credit lines with terms categorically different from anything in the standard catalog, trusts, vehicles and structures that require a certain relationship level to access. These are not gifts. They are introductions to a different world of products and an implicit indication that the elevator to the next floor is right there, available to you, if you choose to take it. Why most people never reach the first threshold, the reason most people never cross the first banking threshold is not income. It is concentration. Banks reward you for keeping your money with them specifically, not for having money in general. A person with $300,000 split across 4 banks and 2 brokerage platforms triggers no bank's relationship protocols anywhere. The same person with $200,000 consolidated at a single institution might trigger all of them. The system rewards consolidation, not accumulation. And because almost nobody was ever told this, most people optimize for exactly the wrong variable. They chase the highest savings, interest rate, moving money between accounts for marginal yield differences, and end up as nobody's priority customer anywhere. The practical implication is almost straightforward. Consolidating assets to reach a bank's threshold tier can unlock fee waivers and rate improvements worth several $100s annually, modest in isolation, but across a decade, accounting for what those saved dollars could have compounded into if invested rather than paid out as fees. The gap becomes meaningful. More importantly, the relationship access that unlocks the conversations you were not being invited into before compounds in ways that do not show up in any simple fee calculation. The second threshold, $200,000 in annual income. This is where things become genuinely structural rather than merely preferential. There are roughly 38 million households in the United States earning above $100,000 annually. There are only about 15 million earning above $200,000. The gap between those two groups is not simply a matter of income. It is a matter of what the law itself decides you are allowed to access. In the early 1930s, following a period of extraordinary financial disruption, the federal government determined that certain investments were too risky, too complex, and too likely to result in total loss for ordinary investors. A line was drawn. On one side, standard investments available to everyone: stocks, bonds, mutual funds, index funds, the things you can purchase through any brokerage account on your phone. On the other side, private placements, private equity funds, hedge funds, venture capital, pre-public company shares, investments that have historically generated meaningfully higher returns than public markets, but that come with higher risk and dramatically lower liquidity. The legal designation for crossing to the other side is becoming an accredited investor. The specific thresholds are $200,000 in annual income for individuals, $300,000 for households, or $1 million in net worth, excluding your primary residence. Cross any of those lines, and the law considers you sophisticated enough to access investments that others cannot legally purchase. Consider what this means practically. For most of American financial history, the asset classes that have performed best, private equity, venture capital, real estate syndications, have been legally restricted to people above this income line. Long-run data on private equity returns shows performance meaningfully above public equity over comparable holding periods. The gap between, say, 10% annual returns and 13% annual returns does not sound dramatic until you run it through 30 years of compounding on a substantial investment. The difference in terminal value is not marginal, it is generational. The legal boundary between accredited and non-accredited investors is not primarily protecting unsophisticated investors from bad investments. It is preserving allocation and the best deals for people who are already above the line. There is a secondary layer to the second threshold that operates entirely inside banking rather than investment law. At around $200,000 in annual income, most major banks reclassify you into what they call private client territory, and the difference between private client and the preferred tier below it is not incremental, it is categorical. At the preferred level, you have a relationship manager. At the private client level, you have a team, a dedicated banker, an investment advisor, a mortgage specialist, and often a credit specialist who can structure lending solutions that do not exist anywhere in the standard products catalog. The mortgage products alone are worth understanding in some detail. Standard mortgages follow conforming guidelines designed for median income earners, with predictable W-2 income, standardized debt-to-income ratios, conventional income verification requirements, and product structures designed for someone whose income arrives in neat bi-weekly deposits. They were not designed for business owners, consultants, commission-based earners, or anyone whose best year looks nothing like their average year. At the private client level, banks offered portfolio mortgages, loans held on the bank's own books rather than sold into the secondary market. These can be structured around assets rather than current income. They accommodate complex and irregular income profiles. They offer terms that simply do not exist in the conforming market. Most people who would benefit from these products never find out they exist. Finding out requires being on the right floor when you walk into the hotel. What the second threshold actually costs you in real numbers. Consider two people with identical incomes both earning just over $200,000 annually as professionals in the same city. Financial twins on paper. The first is banked at the same national institution since her early 20s. She has a checking account and a savings account there, with a combined balance of roughly $40,000. Her investment account sits at a separate discount brokerage. Nobody at her bank has called her in years. When she applied for a $400,000 mortgage, she went through the standard process and received a rate of 4.75%. Monthly payment, approximately $2,090. The second was advised by an accountant to consolidate his banking and brokerage accounts at a single institution to reach their private client threshold. After moving his investment account over, his total relationship value crossed $220,000. He received a call from a relationship banker who mentioned, almost in passing during a financial review, that the bank offered portfolio mortgage products at his relationship tier. He applied for the same $400,000 loan. Because his income was assessed through a different framework and the bank retained the loan internally, his rate came back at 4.25%, half a percentage point lower, on a $400,000 loan over 30 years. That half-point difference represents approximately $37,000 in total interest. $37,000, gone or not gone, based entirely on whether he knew to ask for products available on the floor above the standard catalog. Runs similar math across fee differences, investment account expense ratios, reward structures, and savings rates across a full banking relationship over a decade, and you are looking at a cumulative difference in the hundreds of thousands of dollars between two people with identical incomes, because one of them knew which floor he was on and deliberately moved to a higher one. The third threshold, $500,000 income, or $3 minus $5 million in investable assets. The third level is categorically different from the first two, in a way that reframes the entire conversation. At somewhere around $500,000 in annual income, or $3 to $5 million in liquid investable assets, depending on the institution, you cross into private banking. And private banking is not a premium version of regular banking. It is a completely different institution that happens to operate inside the same lobby. At the lower tiers, the bank is doing you a favor by offering you access to better products. At private banking level, the dynamic inverts. You control enough capital that the institution genuinely needs your relationship. Their quarterly results can be materially affected by your decision of whether or not to keep your assets there. The bank comes to you. They propose structures tailored to your specific situation. Fees are negotiated rather than received on a schedule. The experience of the entire relationship reverses. Goldman Sachs Private Wealth Management typically requires approximately $10 million in investable assets to access. JP Morgan Private Bank operates at a similar level. Bank of America Private Bank begins around $3 million. At these levels, clients receive access to investment opportunities that never appear on any public platform. Private credit transactions, structured real estate partnerships, pre-IPO allocations in companies that have not yet filed public documents, syndication opportunities in markets that simply do not exist publicly. This is not a historical relic. It operates today in completely legal form. Because the compliance and administrative overhead of offering these opportunities to retail investors makes it economically viable. So institutions do not offer them broadly. They offer them to clients on the 22nd floor. The architecture of the thing, the system, is not designed with malice. It is designed with economics. Banks are profit-maximizing institutions. They allocate their best resources, best products, best people, best access to the relationships that generate the most revenue. That is not a conspiracy. It is a business model. The genuinely unsettling part is not that wealthy customers receive better service. It is that the thresholds are structurally self-reinforcing. The people who most need better banking products, lower fees, better rates, Better investment access are precisely the people below the first threshold. The people who least need the advantages of private banking are those who have already accumulated $10 million in liquid assets. Maximum advantage delivered to minimum need. Minimum advantage delivered to maximum need. That is not an accident. That is the architecture, which means the only way to engage with this system productively is to understand it first, and then engineer your own position to cross each threshold deliberately, rather than waiting to discover them by accident after the fact. 3. Practical actions. First, consolidate toward a single institution to reach the first tier. If you are within striking distance of a bank's preferred client threshold, it may be worth moving accounts to get there. Run the math honestly, model whether the fee savings and rate improvements outweigh any disadvantage from consolidating. For most people who do this exercise carefully, consolidating wins, particularly when relationship access is factored in. Second, treat accredited investor status as something to engineer intentionally rather than something that happens passively. Once you qualify, approach private investments with the same rigor you would apply to any serious decision. These carry no liquidity, significant minimums, and real risk. But the right ones can alter your long-term return trajectory in ways public markets structurally cannot replicate. Third, understand clearly that the third threshold almost never arrives through savings rate or income alone. The people who reach private banking territory generally own something that compounds faster than their salary. Equity in a business, a real estate portfolio generating appreciation and cash flow, startup shares from a company that grows. The standard financial planning framework gets most people to a comfortable retirement if executed well. It does not get most people to the 22nd floor. For that, you need ownership of something that grows on its own logic, not just on accumulated labor. The bank already knows exactly how far you are from the next floor. They are watching your deposits, your investment balances, and your total relationship value in real time, waiting for you to cross the threshold before they introduce themselves. They will not tell you what is waiting on the other side. The elevator is right there.